US dollar has tumbled to a 3-month low after the Treasury Department stepped into the bond market to halt a sharp sell-off that had pushed long-term yields to their highest levels since 2007. The intervention came as a global bond rout intensified, fueled by concerns over rising government debt and geopolitical tensions. The lack of progress in ending the US-Israeli war on Iran, combined with fears of higher oil prices, added further pressure to markets. Now, the Treasury's response is easing pressure on borrowing costs, but it is also weakening one of the dollar's major sources of support. To calm the sell-off, the Treasury unveiled plans to double its liquidity support buyback operations for longer-dated bonds while shifting more government borrowing towards short-term bills. The strategy was aimed at reducing pressure on the long end of the Treasury market, where yields had surged sharply. The impact was immediate. The 30-year Treasury yield fell 9 basis points to 5.184%, pulling back from the 19-year high of 5.337% reached earlier in the week. Analysts said the tactical move successfully capped yields without requiring the Federal Reserve to expand its balance sheet. But lower yields dealt a blow to the US dollar. The dollar index dropped to 98.854, its lowest level since mid-May. Analysts warned that the intervention had stripped the currency of one of its key pillars of support and suggested that the dollar may already have passed its high for the year. Other major currencies strengthened as the greenback weakened. The euro climbed to $1.1674, its highest level since late May. Sterling rose near a 3-month high of $1.3614, while the Japanese yen strengthened temporarily to 158.55 per dollar, moving away from the closely watched 160 level. The Swiss franc also remained near recent highs. The timing of the Treasury's program is drawing particular attention. Buyback operations are scheduled to begin on September 9th, just ahead of a key 20-year Treasury note auction. The Treasury is also expected to release details about future buybacks on November 4th, the day after the U.S. midterm elections. Strategists believe this could leave the door open for increased purchases if market conditions require further action, potentially giving policymakers another tool to manage pressure in the longer-dated bond market. However, the intervention could complicate the Federal Reserve's battle against persistent inflation. Minutes from the Fed's latest meeting show deepening concern among policymakers, with several indicating they are prepared to raise interest rates if inflation fails to move back towards the central bank's 2% target. The Treasury has now acted to bring down long-term yields, while the Fed remains prepared to keep borrowing costs high or raise them further.